Hi, welcome to today's video. We're going to be talking about 5 near retirement insights that I hope you find very useful for you. This is from a recent survey of retirees and near retirement employees, and they asked them a number of questions around financial planning, around retirement, and I've summarized it down into 5 of the biggest insights that I think you'll find useful. All things around, how much money do you think you're going to need in retirement versus what the retirees said they actually needed. Things around employment. Are you going to work in retirement? Do you need to work in retirement? So many valuable insights that I think you're going to really love. So stick with it. Now, I've heard your comments, your requests about trying to make these videos a little bit, not faster, but shorter. And I'm trying my very best. But you know what? This information is so useful for you. And for me to just blast through the information, I don't feel comfortable going so quickly through the material, especially when some of it is so complex. So bear with me, but I'll try to get through it as fast as we can, okay? Let's talk about the first insight. This one is actually not surprising. I don't think you'll find it surprising as well, and that's people are delaying their retirement. Now, why are they delaying their retirement? For obvious reasons. COVID has actually put a real hold button for a lot of people making decisions around a lot of different things, around buying a new home or big expenses, where they might work, preventing them from moving forward in their occupations because of the disruption in employment, seeing markets come down and your balances in your portfolios dropping, home values are beginning to drop. We're in October 2nd of 2022 and we see that we're no clear path right now out of the mess that we're in. We still have high inflation, which is going to persist for a while. And so a lot of people are thinking, should I be retiring in an environment like this, or should I just work another year? Well, in fact, retirees are deciding to work up to 4 more years to just give themselves some extra time beyond this period, and also to make sure that their balances recover. So let's look at some of these bullet points here. Pushing back retirement date. Near retirement persons expect to work 4 years longer than they originally planned. They also plan to work during retirement to supplement their income. And right now, and this is one of the insights that it was a little bit I was shocked by, but it's not shocking to me from my clients because I go through this so deeply with my clients. But being confident about how much income they might have during retirement. A lot of people near retirement are unclear about this, so it's really, really important that you understand exactly how much money you're going to have from your investments at retirement, and also nail out what is your expenses going to be looking like as well. Now, if we look about income expectations, there's a significant difference here between the current retirees and the near retirement employees. So let's look at this. Current retirees expected to save around $327,000. That's what they felt they would need roughly for their retirement. Now, this is because many of these people had defined benefit pension plans. Think of the generation that's retired now, and certainly the one before them. Their whole concept, or what was drilled into our heads, was go to university, get a good education, find a great employer, and you stay with them the rest of your life. And participate, and then you would get their defined benefit plan, so participating in their pension plan. So many of these employees retired with their retirement kind of figured out already. They knew they were going to have this amount of money, plus Canada pension and old age security, and they knew exactly what their income was going to look like for the rest of their life, and that was fairly guaranteed. So they didn't really have to save that much more, and when you also have a defined benefit pension plan, there isn't a lot of room to save in RSPs as well. So you have to save in other accounts, but you can see on the left it's a lot less than what the near retirement are thinking today. It's almost double here. In fact, it is double the amount that people are thinking they're going to need to save through the retirement. And you know what? They're not wrong. And why is that? Because many of these people will not have a defined benefit pension plan unless you're a public service worker or a government employee. Very few employers have defined benefit plan. So you have to save your money yourself within your group retirement plan. and it's called a defined contribution room or defined contribution plan. And that is you putting your money into the pension plan, you investing, that means choosing the investments, and then that is all on your shoulders as to how much money you're going to have at the end, and none of it is guaranteed. So you end up, because of that one thing of that, knowing that it's not guaranteed, you start I don't want to say overcompensating, but you certainly don't want to miss the mark. So you end up saving much more than you're probably going to need. And by the way, an insight here that's not part of this survey, I see so many people who, in my 20 years, retire with money in their RIF accounts. They didn't spend all their money. And in fact, the government just takes half of it, roughly half of it, when the person passes away. So it's really important that when you start saving for retirement, you really think clearly about how you're going to use your money in retirement, how much money you're going to need, so that you're not dying with a lot of money that you're just going to give to Revenue Canada at the end. Okay, let's move on to the next one here, strategic retirement. This is about decumulation. Now, I get this question all the time. People ask me, before they've even figured out how much income they're actually going to get out of their portfolio, or before they've even figured out what their expenses are, they're asking me, from which accounts are we going to do withdrawals from? And I say, whoa, wait a second. Let's do the other parts first. Let's figure out exactly how much money you're going to need in retirement. And let's figure out what accounts you can save to right now, depending on your employment. What are the better places for you to save money? And then how you're going to use this money. And then through our financial plan, we'll actually figure out which accounts are you going to draw down on first. And this is a really important consideration for your retirement, because it just doesn't make sense just to say, well, it's automatically going to go from an RSP to a RIF, and that's how you begin your decumulation stage. So that's not a given. Each person is different. So let's look at the income gap. This is one of the questions that was put to retirees, is how much money are you spending right now in retirement versus near retirement employees thinking about how much money they're going to need. So the reality and the expectations are way off. In fact, Canadians spend 27% less in retirement than they originally expected. Now, I'm going to say this with a huge asterisk, okay, beside this slide. And the reason for that is because the people who were saving, and when they did this survey now, you can see the retirees said, hey, we're only spending $2,600, and near retirement employees say we need to spend an extra $1,000 a month. And so what I would say to you is the difference here going forward is that certainly over this year and the next year, that it's going to cost more for both of these individuals near retirement because of inflation, right? Things have gone up in price. Home prices have gone up in a great amount. And so the amount of money you're going to need in retirement is actually going up, more so in these next few years. So the big surprise for both of those groups is, and I think you're probably aware of this, it's no surprise to you, and that is sometimes you got to be thinking about how, and this is one of the I don't want to steal my thunder, but there's going to be surprises along the way, and you have to be ready to absorb those surprises, okay? So let's look at the income gap expectation versus reality. Let's look at the first one. So income from work pension plans. Retired persons, 42% of their money came from their defined benefit pension plan versus people who are currently employed, it's only 35%. And that reflects this trend, not recent trend, but a trend of where employers were dumping their defined benefit plans for defined contribution plans, right? Money, the next column, money from your savings and or investments. 25% for retired persons. That's because their savings was actually their defined benefit pension plan, so they had less savings, whereas the people who are currently working today, they're going to be using their savings. It just makes more sense because they don't have a pension plan. Income from government pension plans, 40% for government workers. So think of the mentality of this generation that's retired, the baby boomers, okay, where they work for one employer, likely one employer, and they had a pension plan and their government, so CPP, old age security. This was I remember my father talking about this for a long time. My father worked for Ontario Hydro for many, many years, retired from Ontario Hydro, had a really good pension, Canada pension, and old age security. And he also worked in retirement because he was an active person and didn't feel like sitting around. So he was doing okay for money. That wasn't an issue. But you can see here that mentality, and his mentality to me was just go work for the government and go work for a hydro and you'll have a really good retirement. And so that is evident in those two answers below. You can see this is how their life was. But the people who are employed today, if you're one of those persons, you're not really thinking about your government pension, CPP, and old age security. In fact, it shows 29%. And that's really what the government is trying to cover anyway, is about 30% of your income right now in retirement. So it's really not, it's part of your planning, but it's not the main thing. For most people right now, the number one question is, will I have enough money to retire? And so they're not thinking about Canada pension, they're thinking about how do I acquire enough money besides the CPP and old age security. Now the last column, which for me was really surprising, the money you will make from selling your home. This was really surprising. Not so surprising for the retired people because, again, pension plan and government benefits. So they weren't really thinking about the house that they bought for $40,000 and sold for $1.2 million will be their nest egg. They're not thinking at all about that because they already had their pension or their retirement figured out. Many of those people took that money and helped their kids get into their first homes or help pay down their debt. So it wasn't money that they actually needed. Whereas people who are employed today, they're saying that if we sell our home, it's not really going to be what we use to retire. And the reason for that is because home prices are so expensive to get into right now that they can't even fathom that their home that they bought for $1.5 million is going to be worth $3.5 million by the time they retire. And so they're not even in that headspace right now to be thinking about that. They're really thinking about how do I pack away enough money to retire. Okay, let's move on to number 2. Wow, well, let's see if we can get through some of these things because some of them are a little bit easier. So this one in particular, retirement planning can make or break your retirement 100% because what a lot of people do, and this is one of the mistakes of retirement, and that is a lot of people just put money away into their RSPs. Are you one of those persons that just puts the same amount away every year? Let's say it's not the maximum, okay? You're not an ultra high and earner. Let's say you're putting away $7,000. The average in Canada is about $5,500, by the way. But let's say you're putting $7,000 away every year into your RSP, and no matter what, you always put $7,000. And you have to ask yourself, why is it always $7,000? Is it just something you did each year, or is that you looked at how much money you're going to get back on your tax return? You said, hey, that's great. I can go away with that kind of money. The problem with doing it that way is you get to retirement and you realize you didn't save enough. And so you really need to match up how much you're contributing against how much you're going to need, and what that, and the middle part of that is how much is that portfolio of money you have going to provide you an income to meet your expense need. That is, or your lifestyle need. That is the real purpose of retirement planning, is to solve that equation, okay? So let's look at that. Well, it all begins with your financial plan. I always say that seeing the outcome of your planning decisions before you commit to them. This is so incredibly important. To say to an advisor, can you share with me 2 or 3 different ways to arrive at this amount of money by this particular time so that we can retire with enough confidence? And can you also give me some expectations around, could we retire a couple years sooner? And what would that look like? Or one of the ways that I help my clients have confidence in their plan is we put it through a Monte Carlo test. Now, just you can read this right on the screen. It's a sensitivity analysis simulation tool you can use to determine the effect of market and longevity risk. So think about this year as a great example. So much volatility, market is going down, bounces are going down, and people think, how does that affect my ability to retire? So the Monte Carlo puts your portfolio through a number of different tests, low return, high volatility, not funding it enough, all these different variations. You can see it down at the bottom of the page. It says alternative 1, 500 trials. So in 500 different scenarios, this portfolio, so your financial plan, was 90% or more hitting the goal that you needed. So this is what you really want. You want that green line to get up to as close as you can to 100, because if your plan doesn't get anywhere close to what you're going to need in retirement, then that plan is not useful. So the plan is really about trying to say, here's what I'm doing today, and if I keep doing this, what is it going to result? Well, this is the financial plan, and doing these Monte Carlo tests, super helpful. If you're not getting this with your financial planning, find somebody that can give you this kind of deep analysis. And why? Because look at this, it gives you confidence. The biggest thing about retirees and near retirement employees, the retirees today said, there are surprises that we didn't expect. We planned for a lot of things, but we never expected COVID and what that would do to us. We never thought that we would have to say, okay, how do we dig into this capital to use that to supply enough money, because it got too expensive. And that was like, think about someone who is going into retirement and they had a plan that they were going to, let's say, buy a new car in 2020 or 2021. And there was no cars to buy. Their lease is up, they got to get into a new car, and they end up having to get into, what a lot of people experience, getting into a used car that was more than the new car. Those are surprises that nobody is ever going to plan for. And so that's where your plan has to say, how much money do you actually have in your ability to weather through something that is unexpected. So that is what a lot of retirees have said, is expect some surprises when you're in retirement. So I'm going to ask you a couple of questions, okay? Just 2 questions. How confident are you in your plan? If you have a plan, only 2 out of 10 people have a financial plan, a written financial plan. So the question is, if you have one, how confident are you in that plan? And then the next question would be, is how confident are you about your retirement income? Now, I ask this for a reason, obviously, and that is, so many people are unaware of how much money they're actually going to have from their portfolio at retirement. And when I say at retirement, think about a 5-year window, because most people don't retire at the date that they thought they were going to retire. The first slide we talked about was people saying we're going to work an extra 4 years. So the idea for you is to really understand how much income are you actually going to need in retirement? How much income will your portfolio actually produce? Look at these slides here. I say this is actually part of a financial plan. It's called cash flow. And I say not all plans are alike. Look at these number of different, these are all different financial plans going through here. And you can see the color code on the screen. That represents different assets that we're using. So whether it's a pension plan, whether it's your RSP that's a RIF, whether it's a non-registered account, government benefits like CPP and old age security, you can see that those colors are all in different orders, because those particular people, for their plans, called on maybe doing an RSP withdrawal early versus riffing, or using their corporate assets first versus using their non-registered assets. It's for everybody, their plan is different, and that's why I'm sharing this screen for you, so you can see that it's not cookie cutter for everybody. This is a plan made specifically for you. And one of the things that I give to gain confidence, and I've shared this with in other videos, I'm not going to go through this. I'll link up here so that you can see what this really means. But basically, it boils down your financial plan into a 1-page document where you can see the most important pieces of your financial plan on 1 page. How much income you're going to need in retirement, what is your income actually going to produce from this portfolio, how much of a balance that you have invested, how much money you have invested, how close are you to retirement. Some really good pieces for you to know on an instant instead of reading a 20-page financial plan. Okay, number 4, this is really important. This is why you're here today, and that's knowledge. Increasing your knowledge as you go into retirement, and certainly while you're in retirement. Knowledge is one of the most important things. Now, it's one of the things that I love doing with my clients If you're local with me as a client, I go and see you in person. But I manage the assets, retirement accounts, life insurance of Canadians right across Canada. And so I don't get the opportunity to go and sit in your kitchen and talk to you, or in your business and talk to you if you're in British Columbia. And so what I do is I have these wonderful Zoom calls and we go through your plan, but we also spend time educating on different kinds of strategies. You may ask me a question, how does this work? And we'll spend time talking about how that actually not just works, but how it may or may not apply to you in your particular situation. And so what I always say is that better questions lead to better outcomes. So this is why your knowledge is so important. Now, the last piece, number 5, and we're there, and that is getting advice. Now, I talked earlier before about how important it is, but I would say to you this: are you using a financial advisor? This was the question put towards retirees and near retirement employees. Are you using, how you get your advice? Is it actually from a financial advisor? Is it just from your bank representative? Is it your neighbor? Where are you getting your advice? But the real question is, where do you get your professional advice, right? And so let's look at the two different groups. On the left, you have retired persons, and 54% of them said, yes, we're using a financial advisor. And despite their situation being fairly, not straightforward, I guess you could say, right? Defined benefit pension plan, CPP, old age security, a little bit of RSP, and then probably a lot of non-registered account because they may have sold their cottage or they may have sold their home. They're sitting on a lot of non-registered accounts. Pretty simple, straightforward plan. They're really concerned about how do we maintain our estate. So they want some estate planning. How do we manage our money through our retirement? They don't have to worry about running out of money, but how do we lower tax rates, which is kind of hard to do for couples like this when they have a pension plan, CPP, old age security, a little bit of a rift pulling into that income stream as well. So tax rates are a bit of a problem for them. And then what they're most concerned is, how do we help our kids out with this non-registered accounts? How do we maximize our estates so that we can actually do more with the money that we've got? The employed people, 43%. This is the one that actually got me really surprised. 43% of people who are working today, who are near retirement, use a financial advisor or have some kind of professional advice. And it's less than the people whose plan was straightforward. These people on the right likely will not have a defined benefit pension plan, so their retirement income stream is all based on their shoulders, their efforts, at the mercy to some degree, some extent, how the markets performed up to retiring and then through retirement. It's all on their shoulders. Their homes were more expensive to buy. Their mortgages, their debts are more than this people on the left. Their kids are struggling to find employment that can pay for getting into a home, so they're having to help their kids out a lot sooner and maybe work a little bit longer so that they can help their kids or even help them get their bills or their debts paid down. Man, the people who are, if you're working today, your situation is so much more complex than your parents and your grandparents. And yet 43% of you using an advisor. So I would say to you, so vitally important to get professional advice, someone that you can trust. So let's walk you through just a couple minutes more and we'll be all done. But let's look at this last slide. I've had this in another slide. It was long ago, probably a year ago I put this up, but it's worth revisiting today. Let's give you some tips how to find an advisor that might be useful. Just not find, but just what you look for. Okay, so advisor B may only have one license. Let's say they only work with mutual funds, and so they can't talk to you really about estate planning. They can't talk to you about stocks if they're only trading mutual funds. They're limited in what they can discuss because they only have one license, right? And you being 50 plus years of age, near retirement or in retirement, you have a lot of questions, as I just mentioned before, and this person may not even be licensed to be able to answer those questions, so they don't talk to you about it. So you really want to work with someone who is multi-licensed, someone who works in the field every day of the things that you're going through. So the areas in which you're concerned about, like estate planning, how to lower your tax rates, wealth management. They might have an insurance license so they can provide insurance for you. So that it's not only just managing your money, but they are able to actually do full financial planning for you. And then advisor B might be a generalist. Now, I don't want to beat up on the banks, so please don't think that I'm beating up on the banks, but I also have a bank account, right? When you go into a bank and you may talk to an account manager that's off the queue where you line up and there's a little cubicle there, so often these people may only have one license. Their purpose there is to help their bank clients. So opening checking and savings account, getting credit cards, maybe doing mortgages, maybe that goes to somebody else. Generally speaking, if you have a large amount of money, they'll refer you to someone in their wealth management division. So they're not really there for like full-on retirement planning. That's not their full purpose, and so they may only be a generalist. So again, you want to be working with someone who is a specialist. You are near retirement, so you're 50 plus years of age, or you're 80 years of age, you're in retirement, and you need someone who is a specialist who works with retirees, or someone who helps someone get a plan together to get close to retirement, and that transition period, which is everyone is so worried about, rightly so. You need someone who's been there, who's got many clients who they've got a lot of information that they can share with you from what they've done with other clients and their experiences. So that's why specialist is good for you in this environment. And the final thing here is captive. We say this is a jargon, a term. This is someone who works for one company and who is encouraged, I'll say that lightly, encouraged to sell only their products. So you look at your investment statement and you see, you'll see only that bank's products, right? Nobody else. It's just that bank product. And you have to ask yourself, does that one bank have the best solution for me? Or is that what this advisor was encouraged to give me? Or maybe they were compensated to promote that. I'm not saying that please don't misunderstand that I think that everybody is in that side of the world is not doing a service to you, but it's just the reality of where they work. This is what they're asked to promote, and that's what they promote. Or maybe they're only permitted through their contract to only offer you those particular products and services. Whereas if you go to an independent advisor, that advisor has relationships with just about every financial institution, every insurance company, and they're going to look for who has the best planning solution for my client right now. What is specific to this person's needs that who would have the product or the planning solution that would help you best? And they're able to go in a number of different directions because they're an independent advisor. Like myself, there's many advisors out there. There's 4,000 or 5,000 at least independent advisors for you to work with in Canada. Well, that's it. I managed to get it done in less than half an hour. I was trying to shoot for 20 minutes, but I went a little bit long because I wanted to share this information with you. Again, on some of these videos, I'm going to slow down and really give you some good insights. And on some of the other videos, I'm just going to like blast through a couple of points and then you'll be on your way. So please bear with me in some of these videos. I always say we take care of your wealth management so you can take care of what's most important for you. I really appreciate you dropping by today and giving me a half an hour of your time. There's my contact information on the screen. Remember to like and share this with anybody you feel should watch this, because of the kind of insights that I shared with you today are useful for people who are retired and near retirement. Again, thanks very much for your time today. I look forward to seeing you in the next video. Take care. Bye-bye.